Sonia, Lata, Prashant, back to you.
All right, Shireen, that's a pretty long wish list, right? And getting only longer by the minute. But I take it that there's lots to watch out for. The three main things that people are looking out for, of course, is credible fiscal math, some SOPs perhaps for the lower end of the economy, and no tinkering on taxes. Sajid Chinoy, Chief Economist, India Economist at JP Morgan, joins us now. And there you have some images coming through of just all the preps before the budget. So, of course, we are just waiting less than half an hour to go and we'll know what's in that budget document. Sajid, we've been discussing the fiscal math for a while, but, you know, of course, the big question is, how does the government generate revenue? Tax collections have been very strong. Apart from that, what do you think the government can do? A couple of panelists spoke to us about how privatization or monetization of public sector banks is a big avenue of you know, generating revenue. What else do you think could be on the government's mind this time around?
Sonia, good morning. You know, I think we have to recognize that two quick points I want to make. One is there's been a very familiar rhyme to the budgets of the last 2 years, and I would expect the government to go down that path. One is to have, you know, credible and realistic fiscal consolidation. Number two is to be very conservative, sometimes too conservative in the tax accounting and the tax buoyancy. And the third is to have the strategic push on public investment, which I think is much needed and required for another year. So I'd expect to see all three things today. Now, here's the thing that the budget will get tailwinds from subsidies rolling off next year. Yeah. The fact that the food program, free grain program, was tapered in December, and the fact that the fertilizer subsidy bill will be lowered next year because global fertilizer prices are lower, could save a large quantum. This could be upwards of, you know, 0.6% of GDP. So in a way, therefore, the entire consolidation and then some could be saved because of lower subsidies, much of which has already happened. And that takes the pressure off the tax buoyancy side. You alluded to the fact that taxes have been very buoyant this year. They've grown at about 1.2 times nominal GDP. We don't need to budget that level of buoyancy next year. Because if all of the consolidation is happening through lower subsidies, you can be conservative in tax buoyancy. And I think this is a year to be conservative because growth is going to slow and nominal GDP will be much lower next year. So a tax buoyancy of 1 will be just fine. And that will still allow you to have non-subsidy expenditure, both revenue and capital expenditure, to remain as the same share of GDP or even be slightly higher. So there's a straightforward way to achieving all of these objectives: reducing the deficit, being conservative on taxes, and still pushing ahead on public capex.
Sajid, 1 minute. Sajid, if we looked at the economic survey, we got the impression they're going with a 11% nominal GDP. And the chapter and verse, they are telling us how GST has been 1.1 in terms of tax buoyancy, and likewise in direct taxes as well. So if they go with a 12% tax growth, then I think your number would be around 23 lakh crore. Let us assume they say 24 lakh crore. You would think that the bond markets will take it badly?
The bond market, Lata, will focus on the borrowing number, not so much on what the tax buoyancy is, because I think the government's been very good in fiscal marksmanship. So when they give a fiscal deficit number, the bond market knows the number will be met or it will be beaten. So I think the bond market will be driven more by what's the net borrowing number, what's the gross borrowing number. Remember, redemptions are very large this year. It's 4.4 trillion. Yeah. Now, within that, there's a GST bond redemption. How will that take place? So I think bond markets will look at that gross borrowing. If it's somewhere between 15 and 16 trillion, I think markets are expecting that, and they will be okay with it. If it's higher than 16 trillion or lower than 15 trillion, we should attract some market reaction.
All right. I like that word, fiscal marksmanship, right? As he said, pretty good at it. They've been pretty good at it. This obsession with fiscal deficit numbers was so, I mean, a few years back.
It looked very good because the states didn't borrow much this year.
Absolutely.
And insurance companies absorbed a lot because they had guaranteed products. Yeah. So on that, Mr. Ashok Wadhwa, first of all, welcome. Thank you very much for joining our pre-budget panel. Do you look at insurance numbers very closely? Do you think that you know, because there were these guaranteed products, you know, bank fixed deposits were not giving much money, a lot of common folk went to guaranteed products. We may not get the same help from insurance companies buying bonds this time?
You know, I'm not sure, because the insurance industry generally is growing fast. If you look at the penetration today in India versus in the US, we have a long way to go. And this particular regulator is very, very bullish on being able to grow. I mean, the changes that he's bringing in the IRDA regulations are just amazing. We haven't seen that in the last 10, 12 years. I personally believe that you will see a significantly larger amount of investment, and you will see a significantly larger growth and penetration in the insurance businesses, particularly the health piece, which is still lagging significantly behind.
And almost all of those stories, not almost all of the stories, all of the insurance stories from IRDA, I mean, our colleagues from CNBC-TV18 have been reporting. Mr. Wadhwa, I want to ask you about capital gains, because for markets, that is the one thing. And many I've spoken to have said, well, kuch to aa sakta hai. Something is possible. You know, they've collected 80,000 crores last year. It's a neat, tidy sum. And it's an area where they can extract more. Of course, market participants don't want it to happen, but what is your sense? Is it possible?
I think before I answer that question, let's look at one important fact, that from kind of single-digit tax to GDP number, we are now low double-digit tax to GDP number. I think we've done remarkably well, partly contributed by GST and partly greater compliance in moving our tax numbers significantly higher. So I don't think there is need to tinker anymore with tax at this point of time. I mean, you're already doing well, you're collecting well. You should lower, you should increase the limits, you should actually put more money in the hands of the common man. And honestly, on the capital gains tax side, if you want to do anything, just collide and collapse. Make 1 year as the single 12-month period to determine listed, unlisted capital gains. Don't tinker with it anymore. The market is in decent shape at this point of time. It's been bruised a little over the last few days, but I think it's coming up nicely.
Just the threshold, make it 1 year. Flat 1 year across asset classes.
That's it. I mean, if you want to keep real estate to 2 because you think there is a speculative element in that, I have no problems with that. But listed, unlisted, just remove everything. I would say even remove the differential in tax rates. Just make it 1, 10%, 15%.
Single tax regime.
Single tax regime for all capital gains
I think
tax.
the market likes what you're saying. So you've come prepared, right? Saying all the right things, wearing that bright green tie, the market going in very bullish into the budget. But anything else that the budget can do that could surprise the markets positively?
Well, I think there's one area where I think the economic survey touched upon it yesterday. If we want to encourage India to start having reverse brain drain in terms of both financial managers sitting outside of India and many of these unicorns setting up their holding companies outside India. Please make it easy, convenient, and provide one time. After all, when you introduce REIT and InvITs, you provided that 1 year transition and said that when you move your assets from companies into REITs and InvIT, you are tax-free. That event is a tax-free event. Having done that, this is perhaps the best time, with India being where it is and perhaps being isolated in terms of a positive dot in the world economy, perhaps a good time to start thinking progressively and saying, how do we move all these businesses and companies, whether set up by Indians or non-Indians? And given that Indian capital markets continue to be buoyant, India continues to attract a lot of investment. Now, don't forget, lots of capital from family offices in India. That's a new dose of capital we haven't seen in the past. We heard about it in the FPO, right? A very large part of the FPO was subscribed by large family offices in India. So that's a demonstration of the fact that there's a lot of capital now in India to be invested in India. So if we can find it, make it easier for companies to locate their headquarters here, swap their businesses down to India, encourage, we've tried to bring managers back to India, the financial managers who are sitting abroad. We've brought in rules each time and tinkered with them, but we haven't still made it so simple. Just make it simple. Bring them here. This is where they want to be, and this is where you want them to be.
Fair point. Let me get Sajid into the conversation on another issue altogether, and we'll toss that to you as well. Sajid, for the first time today, maybe on a rare occasion, the stock market community was asking that there should be more for the lower echelons of society. I think Saurabh and
Decoded, and I think Nilesh also
spoke about it, saying that we don't see FMCG companies losing out on volume growth. Two-wheelers are not doing too well. So never mind if capex spend is a little less, but there should be more programs for the bottom of the pyramid. Your thoughts?
I think first we should recognize that fiscal space here is limited. The finance minister has limited degrees of freedom for all the reasons we just mentioned. that you want to bring the deficit out and make sure you don't spook bond markets. You want to be conservative on tax revenues. And because state capex has been lagging and PSU capex has been lagging, the center can't take its foot off the capex accelerator. My own personal view is 3 years after the pandemic, right, the way to alleviate scarring at the bottom of the pyramid is not through any temporary measures, whether it's cash handouts or we've had a 3-year food grain scheme that just was rolled back in December. I think at this point, any shock for the residual people at the bottom of the pyramid is deemed to be permanent. How do you address a permanent shock? Through job creation. It's only when people at the bottom of the pyramid have confidence, jobs are back, they have income certainty, job certainty, will consumption pick up on a sustainable basis. So I'm very old school about this. I think we've begun on an infrastructure program, construction heavy, which creates blue-collar jobs at the bottom of the pyramid. We need to double down on that approach this year and importantly, take the states and PSUs with it. If we can get another 12, 24, 36 months of a big construction push and create those blue-collar jobs, lower end consumption will take care of itself. Otherwise, I think all of these measures are temporary. You may get a little boost for a couple of quarters, but this ultimately comes back to job creation, blue-collar job creation.
Okay, all right. Sajid, pleasure speaking to you. Thanks for your quick take. Well, we just have less than 15 minutes before we get the budget speech going. And we're going in strong into the budget. No two ways about that. The Sensex up almost 550 points. The Bank Nifty up 630 points. And in just a while, the Cabinet has approved the Union budget. So there we have it. In a while from now, we will know more. Joining us now is Mahesh Nandurkar of Jefferies to give us his view. Mahesh, this is the last full budget before the election year. So, you know, there is, of course, a lot of perhaps populist measures, something for the rural economy that's expected. But you tell us, what tops your list this time around?
I think this is going to be the, I would say, somewhat a pre-election budget, although not technically, because with the change of date to 1st of February, even the next budget will also give like good 3.5 months before the elections as well. And in fact, we did see in 2019 budget as well that there were some important schemes like the farmer cash distribution scheme was launched, etc. So yeah, so it's not necessary that everything that the government has to say politically, or even from the economic perspective, will necessarily be done in this budget only. But yes, I think given the backdrop that we have seen a kind of a K-shaped recovery in India over post-pandemic, I mean, it's quite logical to expect that the government might look at this budget, as a measure to somewhat, bridge the gap.
Mahesh, I know that you've been at the margin a little worried, and you've been talking to your clients as well that there could be something on the capital gains tax front. And you've been saying that investors you speak with are worried as well. So just your thoughts on it in terms of what we could see and what's the fear. Go on.
Well, I mean, it's very much within the realm of the possibilities, and the government has all the right to change the rates of taxation. And I don't know about this year's numbers, FY23, but last year, FY22, there was substantial mobilization that was, almost to the tune of around 70 to 80,000 crores, which was mobilized from the capital gains tax collections on equities. So, that is a reasonably large pool. So, that can also be looked upon as a resource mobilization measure as well. But yeah, the thing is that over the last 1 year, the markets have pretty much moved sideways. In fact, last 15, 16 months. And given the kind of global backdrop that we are looking at, the probability is that we are not going to be seeing a runway market, stock markets over the next 12 months. So changes in the tax rate itself, might not really lead to any significant gains. In fact, some adverse changes could lead to some capital losses, at least in the near term. But yeah, that's always a possibility, and that's a key risk factor, I would say, from the market standpoint.
Okay, Mahesh, thank you very much for that. I guess, yeah, we have enough money, and markets don't need a shock at this juncture. Would be two good reasons not to touch it, but let's see. Let me get another big market voice at this point in time, a veteran of so many budgets. Ramesh Damani is joining us. Mr. Damani, let me get away from all this capital gains for the moment and get to the big numbers. fiscal deficit. The chatter is that it has to come down from 6.4 to 5.8. The reason being, interest payment is taking away some 23% of the total government's expense. And it's 38% of the government's revenues that interest is consuming. So will you watch the deficit number very carefully?
You know, there's an HSBC report which says that, you know, in championship cycling, it never gets easier. You just have to go faster. I think that's an apt illustration of the fiscal deficit number. It used to be, if you remember, in the 90s and the early 2000s, that was the singular number that the market looked at, and the budget would fall or rise based on that number. For some reason, post-COVID, the numbers become more relaxed. We're expecting to come in at 6.4% this year. The government has a glide path to 4.5 in the next 3 years. So we would expect 0.8 reduction in each of these years. So we would expect next year's to be around closer to, I think, 5.8 or something in that neighborhood. So it is an important number, but for some reason, the market is a bit more relaxed about it in the post-COVID era. But the other number that I would pay a lot of attention to is the current account deficit, which has been running at 4.4%, which is unusually high for us. And with oil prices coming down, that should be tempered a little bit. But I'm actually more concerned about the current account deficit at this time.
Okay, so the current account deficit is more concerning to you than the fiscal deficit number. Got that. But, you know, stock market participants are terribly worried about any changes to tax rates on short-term capital gains. What if they're equated with debt? What's your take on what to expect this time around?
You know, there's an old saying which I love: why kill the goose that lays the golden egg? I mean, short-term capital taxes, to my estimation, a few years ago, raised 8,000 crores. Now the number in total capital gains is about 80,000 crores. STT, which you'll recall that Yashwant Sinha started, was, you know, maybe a few thousand crores when he started it. Now raises 30,000 crores. So the markets have to be buoyant. And if you raise the short-term rates to debt rates, which is about 30% of the marginal tax rate, it would impact the prices of the stock, it would impact sentiment of the stocks, and it would impact volumes in the market. So I don't think it, it makes too much sense, particularly when you have such a buoyant period ahead of you in terms of stock collections and receipt collections.
Mr. Damani, a more general question to you. What do you want to hear on the budget? What would make it good from a market standpoint, according to you?
Other than the fiscal number and the traditional things you look for in the budget, I particularly have three things that I look forward to. One, of course, is the disinvestment number. But to be very fair with you, that has always been a disappointment. Ever since the Vajpayee administration 20 years ago privatized IBP and BSNL, as you recall, I think that has been basically a failure or lack of political muscle behind it, which surprises me because, you know, the government has a majority in Lok Sabha, a majority in the Rajya Sabha, and they publicly said that they only want to keep strategic enterprises and not the non-strategic PSUs. Despite that, the progress has been almost glacial in manner. But still, you know, out of habit, I look at that number very closely. The two other numbers that I'm particularly interested this time is the defense capex outlay and the railway capex outlay, because some of the shares that are now listed directly benefit from that outlay. And while the order books are still fairly robust, it never hurts to have a few more thousand crores of orders. So I would look at those three numbers particularly closely. Those are the ones that, you know, the other ones, the outlay for rural health, education, all are important. But from a market perspective, those three are important to me.
Okay, now let me just put Prashant's question on its head. What do you definitely not want to hear in the budget?
Well, two things. One, I don't want ad hoc changes. You know, we have a tendency to move from a zero capital tax regime to, 15%, 10%, and then keep thinking of raising it. So I don't want ad hoc changes. You know, the government has telegraphed its intentions and it should maintain that. I think the one that would really worry the market, and there was a lot of rumors about that going around maybe a year back or 6 months back, but I haven't heard too much chatter right now, is the government is rethinking of introducing a wealth tax or an inheritance tax. And that, of course, would be extremely negative for the market at this point.
Well, that's the ask every year, right? No reintroduction of wealth tax or inherent tax. But I'm sure you'll agree with me that so far the spending has been more government-led. But now there are talks of a pickup in private capex as well. Will the capex percentage or the PLI announcements be something that you'll watch for in this budget?
of course, those are very important numbers because it indicates the degree and the quality of fiscal consolidation. Instead of paying subsidies, you're doing investment. I think the number I've heard is about 9 trillion in terms of capex and 1 trillion in transfers from the federal government to the state government for long-term capex, 50 a loan type of things. So which brings us to about 3% of GDP for capex, which is a good number considering the last few years. But compared to what was in the 80s and 90s, it's still below that high water mark. So it is clearly good for the fiscal consolidation. But we are seeing some revival of private sector capex too, particularly in industries like cement. So I think the capex number is something that is watched very closely. In terms of P&L, that's been a big winner for the government, big winner for the country. I think given the trouble China is going through it right now, the idea of China plus one has firmly taken roots. Maybe China plus two, that includes Vietnam and India, because Vietnam is the more popular destination right now. But I think the government has been ahead of the curve in terms of its emphasis on PLI. And I think particularly in some sectors like semiconductor or in some other sectors in terms of energy, that would be money well spent.
All right, Mr. Dhamani, that was very helpful. And as always, great seeing you on the channel and chatting with you ahead of the budget. We're just counting down to the big budget. So let's just summarize it. Several dimensions on which the market could rate the budget this time around. A transparent and credible fiscal math, a continued thrust on capex, an improved and simplistic tax regime, and addressing any kind of liquidity or bond market concerns as well. That seems to top the charts, and no tinkering of taxes, especially on the capital gains end. That's at least what the market is expecting. But any final thoughts, gentlemen? Mr. Kanabar, anything that I missed out?
No, I would agree, and I think the point which you last made on PLI is going to be very, very important. That's been one area where government has done exceptionally well. So that 15% rate of tax for manufacturing companies continuing in PLI should be a very good booster.
Okay. Mr.
You know, yesterday at a seminar in Miami, Nassim Taleb, the author of Black Swan, made a prophetic comment. He said the world has to understand and live in a high tax regime, which effectively means that most Western countries who have seen easy money over the last 15 years are going to struggle. In that sense, India should not forget, we are used to a high interest regime. And in that high interest regime, it's one more reason why we will be able to navigate and be more competitive, do everything to support and relocate manufacturing to India, because much of the world is going to be troubled by this high cost of capital.
Oh, absolutely. Big debt is a problem, and huge government debt after the way they have spent for COVID. Something which we didn't go overboard. So definitely we are better placed on that point. But Mr. Kanabar, just a last point, anything on real estate? I mean, we keep believing that is the engine, and it's already on an uptake. So, you know, more housing SOPs, principal interest.
So, there has always been this demand that this interest cap on the second house be removed.
Yes.
And I think the response that I have had thus far, when I've interacted with the Ministry of Finance on that, has been that that's not what we want. We are okay for complete interest reduction for the first house, but second and third house is luxury, and we don't want to promote that. But if that happens, that could be a real big booster for that industry.
Mr. Kanabar, just one more thing. We were talking about this capital gains business. Is it possible that equity, I mean, we talk about harmonization, is it possible equity stays untouched? Okay, I think we'll come back to you. I just want to toss it across to Shireen in Delhi. Shireen, over to you.
Well, you know, Prashant, 2 minutes to go for the budget, and of course I have Tarun Bajaj right here with us.